Well, we're going to talk about taxation. The way this workshop came about was a lot of people don't understand taxation in Canada. You don't learn about it in high school. You don't learn about it in university. You don't learn about it when you get a job. You don't learn about it when you get married. You certainly don't learn about it when you get divorced. When you pass away, you have no idea how it works. Is that about correct?
Yep.
Did you know that CRA has a taxation liaison department? You can call them and they will either meet with you one-on-one or do group workshops like this and teach anything CRA does to the public in a group format, or you can meet them one-on-one, kind of like meeting with a lawyer who's on your side. And you can call them and go through any question you want because they teach me how to do bookkeeping, teach me how to do whatever. It's just a CRA liaison. Everyone heard of that guy? Nobody has. It's on CRA's website and it's just a note. But that's stuff that exists that a lot of people don't know. If you open a business, you can call them up and say, how do I set up the business? And they'll meet you in person and walk you through how to set up in a corporation. They can do everything for you because CRA wants you to do well. Because if you make more money, guess what?
They collect
more money. And if you don't get audited, they don't have to pay for audits, right? But we're going to go through this. The information. One of the weirdest things you can do is have an agenda when you talk to somebody. So if I say, hey, I have an agenda. Would you like to do RESPs for your kids? It sounds weird, although sometimes it works if you do it enough. It's just not very listening. And the way people sold in the 80s is nobody knew anything, so you could just tell people what to do. But in 2024, most of our clients know more than we do because they have money and they're doing things. So I can actually meet someone, present a little bit, and then listen to what they want. Does that make sense? Mm-hmm. And then you know what to sell them. But if you have an agenda going in and they smell the agenda, they decline to meet you. Anyone ever experienced that? Yeah, I don't like that idea. It's a bad idea. And so when we talk about financial education, if someone says, what do I do financial education? I'd like to show you the curriculum. It sounds very opening. Is that correct? If I say financial education, most people say, well, what is that? What do you mean? Then I can go and I can talk about what it actually means. And we want to do a holistic approach. And so today we're going to talk about tax, how it works, and what that looks like. The wealth formula is in our workbook. And basically it talks about money, time, rate of return, inflation. We cover that a lot in our workshops because we control that, but we don't talk a lot about tax. Is that true? On Canadian tax, here's how this thing looks. What we're going to learn is when you make money in Canada, can you keep 100% of money you make?
Sure.
You cannot, unless you're poor, right? So we're going to talk about what's subtracted from Canadian income, different structures of earning income. When you went to high school, they said you should finish high school so you can get a what? A job. Did they say you should finish high school so you can incorporate?
No.
Did they say you should finish trade school so you can be self-employed or sole proprietor? No, they said you should get a job. And there's nothing wrong with that, but there's other options. We're going to talk about different structures, and then we're going to bounce around different taxation of investment products. Did you know that if you are a saver, you will likely pay more tax than if you're a spender? How's that work?
More wealth at the end of the year?
Because you have more money. If you're investing and that money is growing, likely you're going to get taxed on it. But if you have a bunch of debt, everything you earn, basically, that's all you're going to get taxed on. But if you're saving money, as that money grows, you're going to get taxed on it. You guys agree?
Yeah.
You're with me? Now we talk a little about common tax mistakes. These things are subtracted from your income. I always look at provincial, it's probably spelled right, federal, retirement, insurance, CPP. What else is deducted from taxes or from your paycheck? A pension? News? Oh yeah, those are good.
Health benefits.
Health benefits, yeah.
Health benefits, dental plan. So a lot of times if you're self-employed, you want to quit brushing your teeth, you go get a job with health benefits, boom, dentist takes care of you, never have to brush again, right? Hey, I hadn't had a job in a long time. I don't know what it's like to have a job with dental benefits where they brush your teeth for you. They go in every 90 days, get the free toothbrush, all that kind of stuff, right? My kid gets that, right? Gets all the toothbrushes. My sister-in-law works at a dental place for kids. You know that one with the little door? Mm-hmm. And if you work there, your family gets free dentistry. Free checkups and all that kind of stuff. So free toothbrushes, free toys, free all pockets full of toys when they leave. We have what's called a graduated tax system in Canada. There's this weird notion where someone says, if I make more money, I don't actually make more money. I lose it to taxes. But if you make more money, you keep more money. There's no way you can make more money and not keep more money because it's called graduated. What that means is we have two main taxes, provincial and federal. This is the federal tax rates. So the first 50,000, you pay 15% to the federal government. Does that make sense? If you earn 56,867, 1,000 more. If you earn 56,867, then you're going to pay 20% on the next $1,000 that's above the threshold. Does that make sense? Now, provincially, they integrate both of them, so it looks like there's 10 tax brackets. It's not. They're just 5 provincial and 5 federal. They don't start in the same place. So if you make 20,000, you're going to pay 15%. But when you start making 22,000, you're going to start adding it up to get to about 50% in Manitoba. So if you make $246,000, does this mean half of it goes to the government?
No.
No. That means the next dollar you earn, half of the next dollar goes to the government. 15% of this goes, then 34% of the gap, and then all the way through. Does that make sense a little bit?
Yeah.
So if you make more, you want to know 2 rates. What's your average tax rate? Which means what's the tax rate you're actually paying? Your average tax rate is the tax rate you're actually paying. Your marginal tax rate is the tax rate you're going to pay on your next dollar. So I don't know if I make an extra dollar, how much do I make? And what's my average? So if I make 100,000, what's my average tax rate? Does that make sense?
Yeah.
We're going to come back to this later. There's something that gets deducted from your pay called CPP. It is a sovereign pension fund. Both the employer and the employee contribute to CPP. If you're self-employed, you pay both. How's that sound? The maximum monthly benefit at age 65 is at $1,300 today. So the way it works is if you make up to 68,000, you pay a percentage of your income. The first 3,500 you don't pay CPP on. And then your employee, you're going to pay 5.95%. It's your employee and your employer rate has gone up, so you pay about 6% in CPP. Or if you're self-employed, you might pay 12%, almost 12%. Which means I'm saving about 10% of my money going to CPP in order to get $1,364 in today's income. That's going to get indexed to inflation. It's what's called CPI. Any questions about CPP? When it comes to our sovereign pension fund compared to the rest of the world, how does ours stack up?
Number 1.
Number 1. It is number 1 in stability, number 1 in payout, number 1 in almost everything. There is one other one that probably competes past it, but not considered a pension fund because Norway, the people don't pay into it. Norway took over all the gas and say, we own all the gas, and then they make money on that and put that in the pension fund. So it's not really a pension fund, it's just a government benefit from revenue they make. You can go to CPP investments and you can look how much money's in there, and they're about 85% equities invested, and they got about $600 billion in the fund. So it's in my opinion, it's rock solid. When someone says, you're not going to get CPP when you get older, I recommend you look them in the eye and say, how do you know that? And now you watch them stumble because they don't know that. They watch TikTok and someone scared them into saving money. This should cover about 25% of your retirement income. For example, if you retired today on $5,000 a month, that would be about a quarter of your retirement income. Fair enough? They're going to take off employment insurance. That premiums are paid by both the employee and if someone's not eligible to claim, they don't have to pay premium. So for example, if I hire my son to do work for me, my 5-year-old, not my 5-day-old, and he works for me and he's employed, does he have to pay EI premium? No, he can't claim. So he can opt out of paying premiums. Family businesses, stuff like that, get into that. If you're self-employed, you can also opt out of this. Because if I'm self-employed and I can't make a sale for a month, can I claim EI? No, I can opt out of paying. I think it's a good idea.
Yep.
So you paid on the first 63,000 you earned, you pay 1.6% of it, and once you've paid $1,000, you don't pay anymore. So if you make $100,000 a year, let's say you make 126,000 a year, the first 6 months you pay premium, but once you've made 63,000, you stop paying the premium. Somewhere in July and August, you get a raise. Same way CPP works. Does that make sense? That's correct, right? You do all this stuff, right?
Yep, that makes sense.
Group retirement programs might come off your check. So many times as a group retirement, when you get a check and it comes out of an RRSP or goes into a LIRA, locked-in retirement account, when you get a deduction, you have to pay tax on the deduction in the future. So if I don't pay tax on it now, then I pay tax on it in the future. That make sense? The chart shows that when you save a bunch of money, let's say you save $1 million in one of these programs. You just start when you get a job when you're 15 and you do it for 50 years till you're 65, you end up with $1 million. They're gonna force you at age 65 to draw 4% of that fund and claim it as income when you convert it to a RIF. You have to convert it at 71. Later on, they're gonna draw 7% or 10%. After 95, 20% a year comes out because the government doesn't want you to die with a lot of lira in RRSP money. So you're gonna force that into income later, which is also gonna force tax on you. What's the consensus on future income tax rates? Are they gonna go up or down, you think? Up? What do you guys think?
Government always wants more cash, so they're probably gonna raise them at some point.
What would be the irresponsible thing to do for the government?
Be accountable.
Lower rates. Let's say I was a TikTok genius and I could get my TikTok ad in front of everybody and I ran for prime minister. And I said, I'm gonna lower the rates to 0. We don't need income tax to run the country. That might be irresponsible, might be the correct thing to do. Do you think there's gonna be someone in Canada that does that in the next 25 years? I don't know. You gotta bet, you gotta decide if, hey, is this a possibility? Or do you think someone runs and says, hey, we're gonna jack up the rates on you?
I don't think they'll say that before they do it,
Before
before they get into office.
When you get group retirement, usually you get to choose the fund you're invested in. You usually have more choices than presented to you. So I have group retirement plans that I sold, and I go to the company and I say, these are the 6 funds you have. It's 5 funds. You have 20% bonds, 40% bonds, 60% bonds, 80% bonds, and 100% bonds. And the rest is in equity. Which of these 5 did you like? And they pick one of those 5. I do it through Mackenzie, but they can pick any Mackenzie fund. But if I'm pitching 50 people, do I want to explain 50 funds to 50 people? Or do I just want to, here's 5 funds, here's 5 funds, here's symmetry, here's this. But if they want more details, they say, what else is there? You could get more. So here's some of the language that gets confusing. A tax deduction and a tax credit are different. How are they different? So tax credits provide a dollar for dollar reduction in income taxes. For example, this is from the Canadian Training Credit from CRA's website. Canadian Training Credit is a refundable tax credit available to help Canadians with the cost of eligible training fees. If you sign on for the HLQP course, it's considered a federal Canada Training Credit eligible cost. So when you file your taxes, you can say, I paid $200 and the Canada Training Credit is up to $100. So you get $100 back in a tax credit. Does that make sense? So a tax deduction reduces taxable income that's paid on your income. So a lot of people think, well, I'm going to spend money, it's a tax deduction. Well, you don't get all of it back, but if it's a tax credit, you do. I love to spend money on tax credits. When you give money to a church or charitable organization, many times you get a tax credit. If you have startup costs in WFG of $700, you can use that all for a tax deduction. The cost of starting a business, any business, can be deducted from your income. Does that make sense, the difference between tax credit and tax deduction? So when your kids go to fitness, they get a tax credit, correct?
Yep.
When your kids go to play guitar, do they get a tax credit, musical tax credit?
Deduction.
It would be a deduction. Depends where you're spending your money. So here's an example. This is a regular paycheck pulled from CRA. Someone makes $2,000 their first paycheck. Darren, if you make $2,000, you don't get to keep $2,000, is that correct?
That's right.
So you're gonna get $80 in vacation pay, maybe 4%. They usually just save that and pay you later, or they can pay it out as you go. You have a federal tax deduction of $190, provincial tax deduction of $147. So you have tax deductions of $338 your first 2 weeks of working. Then you got CPP of $105. You have EI of $34. So you're keeping about $1,600. Does that make sense? That's how normal paychecks look.
Yeah.
Can you control these numbers?
How if you work for somebody else?
Well, watch this. Let's say, here's an example. You earn $2,000, but you keep $1,591. Here's an example, is if I were to put $200 into an RRSP. Now, my net pay is $1,446, reducing my income by only $145. So I deduct $200 from my income, but I only see a drop in pay by $145 because I get a $55 tax reduction. I'm paying less tax by buying an RRSP. Does that make sense? Now, if you have 6 kids or more, you also get a 31 cent per dollar increase in your CCB. So now someone might get, if they put $200, 61 extra dollars in child tax benefits. So if you reduce your income when you have kids, your child tax credit goes up and your tax goes down. Does that make sense, the different levers you can pull? So child tax credit comes in play, Later on, GIS comes in play, OAS could come in play, free furnace from Manitoba Hydro could come into play. You know, you get free benefits. I had a friend that just did his windows, Manitoba Hydro paid for it because he's a low income guy, except he runs a business and makes a lot of money. But, so, does that make sense what a basic paycheck looks like? There's 5 things that are usually deducted. What are they?
Yeah.
CPP, one per person, EI,
Federal tax.
federal tax, provincial tax, and usually a savings program. Unless you have a crummy low-skill job, no savings program. But most high-skill jobs have a savings program because you're knowledgeable to know you're not going to work there forever. 85-year-olds don't work. Okay. Now we're going to look at different structures of earning. By the way, any questions about what gets subtracted from your income? Do most people understand that stuff?
No.
No,
I don't think so. But if you understand it, it makes you way more powerful as an agent. So we got employment, we got a sole proprietor, to say, yeah, and corporation. 3 main ones we're going to talk about today. So employees have little control over the taxable income. Taxes are usually deducted at the source before you even see your paycheck. You don't even hire a bookkeeper. The company you work for hires a bookkeeper and they do your taxes. They estimate it. Things to focus on if you're just an employee: tax deductions, tax credits, and possibly investment tax planning, but you don't really need a bookkeeper. Should an employee keep all of their receipts they spend money on?
Employee.
Should an employee?
Everybody
only if they
should.
work from home.
Let's say more about everybody should.
Everybody should keep their receipts just in general. It's just good tax planning for filing your personal taxes. But if you spend money on your job, doing things on your job, there's a line on your personal taxes called employment-related expenses
Yeah.
that you can deduct from.
Everybody should have a shoebox from Dollarama for $4 and keep every receipt they spend. If you're an adult, you don't track your spending, it's foolish. It's ridiculous. Because people don't know what they spend on. You say, well, let's check. You can actually go back and check when you have paper. Does that make sense? My son, who's 5, has no idea what he spends money on because he doesn't track it, keep a receipt, nothing. And I have adults who don't track or anything either. I think it's equally as ridiculous as the 5-year-old, except the 5-year-old has no budget. Any questions about employment? There's not much to go, not much to talk about. You make money, you pay tax on that money. It is the worst way to earn money in North America because it has the highest tax and the lowest freedom, and it is more addictive than cocaine. Most people never recover from it. Yeah, there is no recovery program. Sole proprietorship, that's spelled correct, right? Proprietorship.
Pro.
Oh, we're missing an R.
So sole proprietor, you can declare sole proprietorship with no government registration or paperwork. One day you just say, I'm a sole proprietor.
People knew.
That's it, I'm a sole proprietor. I have intention to make money, I am going to draw art and try to sell it. I'm going to, and your idea makes you a sole proprietor. Anybody can earn money in Canada, there's no restrictions on you earning money in Canada, unless there's a professional license restricting you. Self-employment is a common form of sole proprietorship. You just be self-employed. You can hire people too, but you can do it on your own. Being an independent contractor is also sole proprietorship, like WFG. You pay tax on your income that's reported after you deduct expenses to earn said income. What that means is, let's say I go get a license for $1,000, and then I write a sale for $2,000. What's my profit on that?
$1,000.
$1,000 because I get to deduct my expenses first. If I was doing concrete work and I bought $1,000 of bricks and charged $2,000 to install it, my profit is only $1,000 because I get to deduct the cost of goods. That makes sense, correct?
Yeah.
Do most people take advantage of this? No, they do not.
Your battery's gonna die.
Thank you.
You're welcome.
Let me switch to this. Let's see. Perfect. It just brightened up. One of them will die anyway, so. Any questions? That's good. We got some more things. You can claim your income as both an employee and a sole proprietor. You could be both. You don't have to be an employee one day and a sole proprietor another day. And your losses can be used against your employment income for what's called a reasonable amount of time. What do you think a reasonable amount of time is for most businesses?
Years.
Amazon never made a profit for 11 years. Are they a legitimate business?
No.
Could they claim those losses from investors claim those losses? Yeah. Now, let's say you don't make money and you don't work and you stay at home. You don't make calls, you don't get a license, you don't study, you don't do nothing. Would claiming losses for 5 years be reasonable?
You don't do anything.
Not if you don't do anything. It's not reasonable. But if you're doing something, then it becomes reasonable. Does that make sense? When CRA uses words like reasonable, they assume we know what reasonable means. We do know what it means, right? The following an example. So there's an employee who has a $12,000 of expenses during their first year setting up their business. So here's what this looks like. Employment is to have incoming revenue, you pay tax on it, and you get to spend whatever's left. In fact, you don't even see the revenue, you just see what's left. True? The independent contractor gets to do it like this. They get incoming revenue, they spend to earn more. What kind of things would an independent contractor in WFG do to spend to earn more money?
And
Buy a license, upgrade your camera, upgrade your computer, upgrade your laptop,
Use your car to go visit people.
books,
Yeah.
fuel, convention, buy your flights. If you got flights happening in like June, and you have a chance to buy them in December, you can buy them in December, keep them in that year, right?
Yeah.
So, you spend money to earn more, then you get taxed on what's left after you've spent money to earn money, and you have a lower taxable income. Is that simple?
I mean, it looks simple.
Let me show you an example, a less than simple example, but it's very basic. This is a single woman with one child. Actual numbers, actual person. Earned income, $40,000 a year or $3,330 a month. Federal, provincial, CPP, and EI, no group savings plan. You guys are okay with those numbers? You can calculate them in your head now, right? So $53 a month in EI. Take home, $2,300. Child tax benefit, if there's one child, it's $541 a month. Child tax benefit is almost like a reverse tax. They have $500 in debt, and they have bills and lifestyle is $2,300 what they live on. Realistic situation, 40 grand a year is living on $2,300 a month. Going towards our financial foundation, zero. Now someone starts here. By the way, can someone reasonably have business deductions of $1,000 a month?
A month?
So it's $1,000 a month. Here's what it looks like. Auto pack, cell phone bill, convention,
Mortgage insurance.
mortgage
property
insurance, laptop, iPad,
Office.
camera,
Office
Internet,
fees.
cell
office
phone.
fees, stuff. You guys could, everything you're trying to avoid paying, that's the deduction, right?
Yeah.
You think of, oh, I don't wanna pay that. That's probably a deduction. It's probably good for your future. No different than if you're trying to lose weight, everything you don't eat, probably good for your future too. So you come up with $1,000 a month. Now your federal tax, all this stuff is adjusted. Notice your EI instead of 53 a month is only 37 a month. Your take home pay, 2707. Now tax benefit instead of 541 is 583 because you have a slightly lower income. Bills and lifestyle, let's assume it's the same, $2,350. If you're bringing home 2707 and you're living on 23, same lifestyle, can you get out of debt?
Yeah, okay.
Can the average person get out of debt with $500 extra a month?
Yep.
So now they're saving $937 a month. That's something. They're not changing anything. Yeah, they scams them and they blame you for trying to get them out. Is $1,000 a month a good deal?
For sure.
I like it. This makes sense, correct? It's fairly true if you, some of you guys do taxes all the time.
That's very average.
It's a normal situation.
Yeah.
Common deductions, lots of things. Should be reviewing that with the person that does your accounting. So, different structures of earning, a corporation. Most people don't plan on incorporating. What they do is they have a profitable business, which forces them to incorporate. There's called a small business tax rate. SBR is called. The tax rate in Manitoba is 9% on retained earnings. Is 9% a good tax rate?
Yep.
Yeah.
So, a Canadian controlled private corporation, or CCPC, it's often referred to, it's a corporation. If you earn less than $500,000, you get the lower tax rate. Your tax filing requirements are stricter because you have to have books. You have to have a bookkeeping. Most sole proprietors don't do any bookkeeping until they do the day before they do the taxes, they make up the books. If you make, let's say you buy an insurance policy and the insurance policy grows, does the growth in an insurance policy affect the earnings $500,000? No, it does not. If they pull money out of that policy, it might, if they pull it out as above the ACV. So you have what's called a net active income, which is not paid out to the shareholders, taxed at 9%. So let's say I have a company and I live on $100,000 a year, and my company earns $100,000 a year, and I take it all as income and I live on it. How much tax is the company going to pay? The company earns $100,000 in bottom line. I take it all out as income. How much money, how much tax does my company pay at 9%?
900,000.
Zero.
To you,
My company has $100,000 at the end of the year. I take it all out and live on it. How much money does my company retain? Zero.
and your company would call that an expense for paying. out-
So most corporations don't actually make money. The owner spends it all on lifestyle, buys a boat, buys a house, buys a car, buys stuff, and money that's spent doesn't qualify for this because I would have to pay income tax on it. Or I get paid, if I take it out as a dividend, I have to pay tax as a dividend. Does that make sense?
Yep.
So if a company is not profitable, by let's say it earns 400,000. And I pull out 100,000, now there's 300,000 left in the company, correct? The money that's left in the company, if it doesn't get spent on things, it sits in the company, it gets a 9% tax, profit only. Not money I spend as a shareholder. You with me?
Which is still better than your other table you were showing with personal tax rates, because the lowest one's 15%.
Yes,
But
but
the money-
it only matters if you make money that is not being spent.
Right.
You spend most of the money you make,
Yeah,
so then a corporation wouldn't help. For most people, if they spend most of the money they make, a corporation doesn't help at all.
Right.
Then you end up with strict tax reporting requirements, and no, you don't save any, there's no retained earnings that you're gonna get taxed on.
Right.
If I retain 300,000 my first year, and the next year I make another 300,000, so now there's 600,000 sitting in my corporate bank account. Do I pay tax on the cash in my corporate bank account or just the profit for that year?
Profit.
Just the profit for that year, so I can start building some money. If I invest through my corporation in a seg fund, in a mutual fund, in an ETF, in anything that's considered a passive investment, it's immediately taxed at the highest rate. So if a corporation says, I want to earn 10% in a mutual fund, and I tell them you could probably get 6% on a whole life. What's better, 10% in a mutual fund or 6% in a whole life?
6% in a whole life.
6% in a whole life, they're gonna keep 6%. 10% in a mutual fund, they're gonna get 50% tax on that, so they only keep five of them.
is it
50%
because
of
it's
them.
an investment?
It's a passive investment.
Okay.
Canadian controlled private corporations are against you using your corporation as a holding company to just shell taxes.
Sorry, so are you saying that the insurance portion is
Non-taxable.
correct?
It's not considered
Okay.
growth.
Yep.
It's not an investment, it's an insurance policy.
Gotcha.
If a Canadian corporation earns more than 50,000 in passive income, so they have $500,000 saved, and they earn 50,000, there's a reduction in the amount of your active income that receives a small business tax rate. So that first 500,000 of profit starts to drop. So if you have a bunch of rental properties and you're earning 70 grand a year, you're no longer a small business. You're gonna pay normal corporate tax rates. That's why insurance makes sense in corporations, because they don't have to pay 50% on passive income in a mutual fund. I don't think corporations should own much mutual funds. Doesn't make sense. You with me? Now, should I incorporate? If you have a profitable business, there's more tax control if you're incorporated. What does CCPC stand for?
Controlled private corporation.
It's almost every corporation is like that. Most corporations are CCPCs.
So there's different types of corporations you're talking about?
Yes, there are. That's one of them. I assume it's one. The stricter tax reporting. So if you're not making money, why would you want stricter tax reporting if there's no profit? When people say, I have 25 real estate properties and I have 25 corporations on TikTok, and that's how I structured it, each one has its own corporation. I'm thinking,
That's
so you spend 25,000 a year in tax filing fees, because it's like $1,000 a year per corporation. They say, yeah, because they're an idiot. To me, it doesn't make sense,
Why wouldn't
because
they put all the rental properties in one corporation?
that's how it is. If all the revenue is drawn out in income, there's no retained earnings to receive the lower tax rate. So when you're advising clients who say, I have a mechanic shop, I make 150 grand a year, but I spend 50 and there's 100 grand in cash growing. I've already paid off all my bills. Should I incorporate? You tell them, listen, all that money you leave in the corporation, you could get taxed at 9%, but as a sole proprietor, they get taxed on 150 grand. Instead of getting taxed on 50 grand of the money they spent and 9% on the 100 grand that a corporation would make. Does that make sense?
That makes sense.
That helps with advice? Can a WFG associate incorporate?
Sure.
No. The WFG associates cannot. You cannot separate your license and your liability from who you are, and a corporation cannot own an agent code. Agent code does fall into marriage separation laws where you can cut an agent code in half and pay a spouse half your income if they've been recognized properly.
Uh-huh.
But a corporation cannot own an agent code. AGUN will not let that happen.
I thought there was people in WFG like that are SEVCs that have corporations that,
Oh, they have marketing corporations, but not their license.
oh, so they're licensed.
So let's say they run a convention, boom, they run an office, boom, they run marketing, boom, they do trips, whatever they do. A corporation cannot hold your license.
Oh, okay.
And by the way, if a corporation does hold your license, they do not hold the legal responsibility for your license. You cannot put that in a corporation. So it's not like real estate where if your tenant sues you, you just shut down the corporation. Here, you are always liable for your own stuff. Does that make sense? A little bit? Well, how is life insurance taxed in a corporation? We know that's not the cash value, just the death benefit. If the beneficiary is the corporation, the death benefit minus the ACB is accessible tax-free. ACB is the premium paid minus your net cost of pure insurance. So if I make a premium payment of $10,000 for $1 million policy, and then I die the next day, insurance policy owned by my corporation, the corporation is the beneficiary, would get $1 million death benefit. Of that, $10,000 minus whatever the cost of insurance on a one-year term would be, call it $50, would be taxable, but the $990,000 would be tax-free. So the growth above what I paid minus the cost is tax-free. The ACB, as you're putting money in, goes up, but once you get old enough that the cost of insurance kind of sucks, the ACB goes down to zero and you have an ACB grind down. Let's go. Most of it's tax-free. You with me? The amount above the ACB is credited to a CDA account and can be distributed to shareholders tax-free. The CDA credit can be used at the shareholder's discretion. Here's how this looks. Let's say me and Darren own a business. By the way, Darren's the guy that recruited me, so most of you never met him. But he's the guy who originally recruited me. And let's say we own a business together and we buy life insurance on him, and he passes away, and a $10 million gets paid out to our corporation. And I'm married and he's married, and his wife says, hey, I want my 10 million. I say, no problem. I would cut his wife a check as a shareholder dividend. Here you go. And then she'd get a $10 million shareholder dividend that's taxable. And I would retain the CDA credit for me and my wife. And so that would be written into the corporate buy-sell agreement who gets the CDA credit. Usually the survivor gets it because both parties think they're going to be the survivor.
Although in your example though, his wife had nothing to do with the business and she wasn't like on the board, could she still get that dividend even though she doesn't?
I could, it's whatever the buy-sell is. Usually she would inherit his shares and I got to buy those shares back.
Oh, I see. Okay.
So I got to buy them with money. And does the money go with credits or no credits? The shareholder chooses. Usually a buy-sell talks about that. If the beneficiary is a shareholder, let's say I buy life insurance from my corporation and I make my wife the beneficiary. Corporate owns the policy, wife's the beneficiary. The death benefit would go to the shareholder, who's the beneficiary. That make sense? CRA would deem it a taxable benefit to the shareholder and tax it as income. They may also deem the premium paid by the corporation a shareholder benefit. So if I'm paying $10,000 a year and my wife's the beneficiary and she's getting some peace of mind, that's a shareholder benefit. That $10,000 would retroactively also be taxed as income. 2 years ago, there was a case, went to CRA, the highest court, and they lost. CRA won. And all the premiums paid in, like $95,000 a year for 10 years, became taxable. And all the death benefit was taxable. And they had policies that weren't paid out. And CRA said those were intended to be paid out and are going to tax those too. So when you review policies that are corporate, you say, why is your wife the beneficiary when it should be the corporation? If it's the corporation, it's almost all tax-free. If it's the spouse, it's not tax-free, but the cash value is protected from creditors because it's a proprietary beneficiary, preferred beneficiary.
Oh, wait, should it?
If a corporate policy, corp should be the beneficiary because the corporate owns it. Who's the beneficiary of its owning? Itself. It can distribute that to the family tax-free. The CDA account was originally started because when you have a capital gain in a company, so let's say I own a company, we do a real estate deal, and the profit on the real estate deal is $100,000. If it's in the corporation, 66% would get taxed, 34% would be tax-free. I could pull $34,000 out as a shareholder through the CDA account, put it in my pocket. So there's ways to get it out. That's where the CDA comes from. It's the tax-free portion of capital gains. Most big moves of $500,000, $2 million, $3 million in a corporation are because you understand the CBA account. I recommend you learn how it works. Any questions about this? When you do a corporate policy, send Equitable an email. Please review this. They review it. Does critical illness owned by a corporation get paid out and trigger a CBA credit? No, it gets paid to the corporation. And if you pull it out, you get taxed as you pull it out, either dividend or income. Okay? So corporates should not own CI unless they're doing a corporate return of premium policy. Let's review. Employment, better level tax control. You guys agree? Sole proprietor. Proprietor. Most of this was spell checked during like a 60-hour typing marathon sitting in a hospital. For you're like, what is proprietor? How do you spell this thing? Very easy to start. Allows deductions against revenue and employment income. Canadian controlled private corporation, you get a lower tax rate on your profit that you didn't spend. Stricter reporting requirements and your cost to open and close. So if you're going to run a business for 6 months, don't do that. Make sense?
Can I ask a question?
Yeah.
When you incorporate, is that the same as registering a business?
No.
Or no? That's two
Two
different
different
things.
Two
So
different
like
things.
getting a registration number, is that still so private?
Yeah,
Yes.
usually.
You have to, when you register it, they'll ask you, like, usually when you fill that form out, they'll ask you, is this a sole proprietorship? Is it a partnership? Is it a
Okay.
corporation?
So where are we at? What's taken off your income? 5 things, maybe with group benefits, maybe. 3 main structures. There's many other structures of making money too. Now we're gonna look at investment products. You with me? You can throw money in the garbage now, you can throw money in the garbage later, or you can try not to throw money in the garbage, okay? Tax advantage means you have advantages before you throw money in the garbage. Everything falls into one of these 3 buckets. There's only 4 tax advantage vehicles in Canada that work very well. It's a tax-free savings, insurance benefits, primary residence, and FHSA. They all have limits or qualifications to get into. RSP, here's the things you need to know. It's tax deductible. Almost everything is tax deferred when it's registered. Not everything, but almost everything. It's a very common benefit. And it's taxed upon withdrawal. Tax-free savings is the opposite. You never have to pay tax. If you take money out, you can recontribute the following year. Your accumulated room is 95,000. So if you're married, you have almost 200,000 of room and you get 7,000 a year. I believe the government brought out the TFSA to destroy the UL market because they said, why don't we just do this? And then there's no surrender fees. They did that in 2008. The FHSA is the combo of RRSP and TFSA for non-homeowners. Homeowners can't buy this. You put $8,000 a year in. You get a tax deduction on the way in, and it's tax-free if you use it for a down payment. And if you have RRSPs, you can roll them into an FHSA and then use them to buy a home because you get the same deduction in an RSP or an FHSA. Does the basics make sense? How's this taxed? Nobody knows. Your deposits, when they're withdrawn, they're called return of capital. Return of capital is tax-free. Return of capital, sometimes we refer to in the industry speak, we say ROC. The ROC is not taxed. How do you spell ROC? ROC. Different from the business model, build the boulder, roll the rock. That's the investment management model. You build the boulder of $30 million, then you roll the rock every time you need money. Your grant, you get 3 times your deposit up to some limits. It's taxable when you pull it out. Your bonds, you got $1,000 a year based on your income, up to 20 grand. They're taxed when you pull it out. And you earn money, compound interest on this thing. It can grow a lot. That's taxed. Not as it grows, it's taxed when you pull it out. So our DSP payments are generally a mix of taxable and non-taxable income.
The assumption here is that the RDSPs will be pulled out by somebody who has a very low income bracket and therefore the taxation is very low.
And whopping tax deduction.
All of these are extra money. This is tax-free, so I would recommend being aggressive when it comes to RDSP investments or being fully invested. It's probably a better term than aggressive. Deposits are withdrawn tax-free, but interest or gains and grants are taxed. Withdrawals used for education purposes are taxed in your children's name. Non-education withdrawals are taxed in the owner's name. And grants are repaid, but interest on the grants are retained and taxed in the owner's name. If the future tax rate on gains may negate the benefits of the 20% grant. Let's say I put in $1,000, okay? And I get $200 in grant. That makes sense? And then in 10 years, that money doubles to $2,400, right? And then it doubles again to $4,800, right? So I got $1,000 in return of capital, rock, and $3,800 in growth. You with me? So $3,800 in growth is a $200 grant, or is tax on $3,800 better? Does that make sense? So if I do the RDSP, I'm gonna pay tax on $3,800. My son would. But if I do a TFSA, I don't get the $200 grant, but nothing's tax-free. I get the $4,800 tax-free, or I get $4,000 out. So I think a TFSA is more efficient than an RESP, especially if the parents want to use it. I just recently did one where the client had $100,000 in RESP. We pulled out all the capital, tax-free, and moved it to TFSA. So it doesn't grow in there. It'll grow in the TFSA, and all the growth we just left in there later. So you can use these you can have them managed properly. Taxation of life insurance. This is why people say tax advantaged, because CRA doesn't like the term tax-free. So if you say tax advantage, they won't chop their fingers off. But if you say tax-free, it has to actually be tax-free.
Yeah.
But it's not tax-free. It's tax advantages. Right? If someone says, hey, how's your wife doing? I say there are advantages. That's not a positive thing. It's a negative thing. So we're going to know what we're talking about. Here's the language you got to know to pass your HLQP and deal with the public in a high net worth space. ACB is your premium minus your cost of insurance. So you know when we run cost of insurance as a line going up, that's the cost of pure insurance. You can lock it in for 20 years, 30 years, 100 years, but there's always a cost of insurance that's on an actuary table you got to pay. That make sense?
Yeah.
And it's in the illustration. You can find it, you can illustrate it. So if I deposit $500 in premium to a policy, and my cost of insurance is $10, my ACB would be about $490. Make sense? ACB is tax-free. The way adjusted cost basis works in real estate, insurance is an adjusted cost basis. This is insurance. Adjusted cost base is real estate. ACB, adjusted cost base is real estate. Adjusted basis is insurance. Make sense? If I buy a property for $200,000, what's my cost?
$200,000,
And I renovate it for $40,000. What's my cost?
$240,000.
$240,000. I adjust my cost by money I put into it. That make sense? And then I depreciate my taxes by $40,000. Now I have an adjusted cost base back down to $200,000. So the cost of a property can be adjusted by what you've deducted, capital costed, or what you put in rentals. An insurance policy is the same way. What you put in, ACB goes up. What comes out in cost of insurance, ACB goes down. The growth is when your cash value exceeds your ACB. By the way, term insurance, side note that may or may not make sense. Term insurance increases the cost of pure insurance, which reduces your ACB faster. So for corporate policies to have a huge term insurance is good because you don't want ACB on a corporate policy, but you want ACB on a personal policy. Because a corporate, you want a death benefit, tax-free, get rid of the ACB, put a big term on. It'll grind that thing down faster. When you withdraw money from a policy, the growth is taxable. Growth equals cash value is more than ACB. ACB is basically what you paid for the first 20 years. Surrender. The policy, when you surrender it, the growth is taxable as income. Not a policy gain is not a capital gain. A policy gain is income. Policy loan. A policy loan, if it exceeds the ACB at the time of the loan, is considered taxable as income. The excess. Taxable loans can be repaid and create a tax deduction. So let's say I have a policy and I put money in and there's $100,000 of cash value, but my ACB is $80,000. ACB is $80,000. Cash value is $100,000. If I cancel it, $20,000 is going to be taxable. If I withdraw, no matter what I withdraw, it's going to come out on a pro rata basis. So 1/5 will be taxed, 4/5 is not taxed. But if I do a policy loan up to 80 grand, no tax. So when calculating a policy loan, just take a loan up to your ACB, tax free. Infinite Banking, they run a policy loan to your ACB in 21 years. And then they take that policy loan and they buy a new policy. And now the first policy continues to grow tax free and your ACB zero because of a policy loan drops your ACB. When you repay it, it increases your ACB and you get a tax deduction. Are you with me or they would lose everybody?
That last one.
That's how it works. A collateral loan. Tax-free, no tax on the collateral loan. If the borrower is the owner of the policy, if I have a corporate policy and I borrow personally from my corporate policy, it's not tax-free. I would have to pay a shareholder benefit or corporate guarantee of 1% is the typical reasonable fee to have a policy guaranteed by my corp.
But if your corporation pulls it up, then it would be taxed.
The corporation will pull it out, it would not count as profit for the corporation, correct? Now, a whole life, you can get collateral loans, 90% up to 15 grand. So you need 16,600 in cash value to get a collateral loan from Ecobank. A UL, you can't do a collateral loan in Canada. I cannot find a place to do a collateral loan in Canada on a UL. I heard they exist, but nobody will borrow against equity in a UL. If you do a collateral loan and later in the future cancel the policy, the loan you took is taxed. Here's what this means. Let's say you do a UL, your cost of insurance get out of control, and you borrow 100 grand when you're young. And that 100 grand turns into 200 grand in 10 years and 400 grand in 20 years. And you just say, I don't like this policy, I'm canceling it. You send a letter to the insurance company, cancel it. They're gonna send a T6 or T7 or T8 or some kind of T-slip to you. T-slips suck, okay? And that T-slip is gonna say you have an income of $400,000. And they call it phantom income because you never actually drew it out. You pay tax on it. You pay tax on the interest on the loan as income tax. That's why lenders don't borrow against UL, because they're gonna get canceled when you're old because the cost of insurance has a chance to get out of control. Whole life, it's paid off, they love it. Almost every institution will do it. Non-registered, are you with me on that insurance? Sometimes this is as clear as we make it, keeping it quick, not quick enough. So non-registered investments, is this helping you guys? Non-registered investments, this is what you gotta learn. Investment gains are taxed as they are earned. There's 4 ways to earn. Interest income. What's the inclusion rate on interest income?
100%.
100%. What's the inclusion rate on capital gains for personal gains under 250? This is not law, by the way. It has not passed. It's just been said they're gonna pass it and retroactively go back to whatever date they said. It's not currently passed. I think it will pass. Dividends have an inclusion rate of what? 138%. If I get $100 dividend, how much income do I have to claim on that dividend? $138. There's a gross up. It's assumed that the corporation, if it's a Canadian corporation, earned $138, paid $38 in tax and gave me the 100. So when I get the dividend, it's 138 of profit. And then what they do is they give me a tax credit of 15 and change to offset the tax the corporation paid. Nobody in high school learns this stuff, correct?
No, I don't remember this class in high school.
It's not intuitive. Nobody in homeschooling learns this stuff. Is that true? You're a homeschooler of 7, of 2, a homeschool 3 now?
I did not teach this.
Right, we're gonna talk about how this applies. And lastly, ROC, not tax. The only time ROC is taxed is in an RRSP. What's the ACB on an RRSP? ACB equals tax-free. So your ACB is always what? 0. What's the ACB on a TFSA? What's the ACB on it? No, it's your market value. Every day when that TFSA is repriced, your ACB is the market value. Because if I have 35,000 in my TFSA and I pull out 35,000, anything above the ACB is taxed, so my ACB is considered the same as my market value. If my investment grows, so does my ACB. So of course, there's no tax because there's never anything above my ACB. If we lose you, we're gonna make sure we all know how this stuff works. So, interest, $1,000, you keep 600. $1,000 of dividends, you keep 800. $1,000 of return on capital, you keep 1,000. $1,000 capital gains, you keep 800. Does all cash flow equal?
Nope.
If you're gonna retire, do you wanna retire on GICs? I don't recommend it. Distributions are not dividends. We're coming up to the end, okay? Distributions are not dividends. A distribution is a payment made from a fund to an investor. It can be made up of interest, dividends, realized net capital gains, or return of capital. Which one would you prefer it's made up of? Return of capital, or possibly dividends if you make less than 50K a year. This can be structured and be dominated in return of capital and be very tax efficient. You with me? Dividends can be earned by the fund holding companies that pay dividends. So if a fund owns 10 corporations and those 10 corporations pay a dividend, you get taxed on the dividend they pay whether you pull that money out or not. The fund grows by 5%, in all dividends, you pay tax on the 5%. It's taxed as it's earned that year.
Even though you didn't use it.
Even though
previously.
you didn't distribute it, you earned it.
Oh, wow.
It's only a component of a fund distribution, and they're taxed as they're earned, not distributed. So a client says, how come I am not taking money out of my fund? I had a capital loss, the fund's at 5%, but I'm paying tax. Well, some of the companies in there paid a dividend, which triggers tax. Non-registered money will trigger a T3 almost every year. You can wash that by learning about T-SWIPs and corporate cost stuff. By the way, people who have lots of investments, mostly life insurance payouts. A lot of people I sell $1 million, $2, $3 million policies. If you have a policy with a couple $1 million and it gets paid out, do you want to pay tax on that all the time at a bank? Interest income, or do you want to deal with someone like me who can control the taxes? I don't want to be an advisor that constantly promises rate of return, and I have no idea if they're going to get it. But if I talk about tax, I know exactly what they're going to get. It's real. Not all income is the same. Fund distribution versus GIC tax. Distributions can be consistent, or market value of a fund can fluctuate. So they could get $1,000 a month and the market could go up and down. You just set it how you want to set it. Capital gains are taxed when realized. So if a fund grows, only the return of capital is withdrawn, the taxes are deferred, there's no tax. You just take your capital out. GIC, it's taxed the year it's earned. I got a client, let's say they got $1 million at 5%, 50 grand a year. They pay tax on that. Over here, but if they cut it over here and got a distribution of 5%, there'd be no tax. Let me show you the graduated tax system. 50 grand, you're paying 33%. If it's a capital gain, it's 18%. If it's an eligible dividend, check this out. If you make $47,000 and it's all coming from dividends, you pay 3% tax. So if you set up your retirement and say, I want to retire and only have dividends coming in and realize them and your income's less than 50 grand, you're going to have 3% tax. Because the corporations that pay you the 50 grand already paid tax on that profit. And you get the gross up and the tax deduction on what they've already paid.
We're going from -3 to 16 to 3 to 6. Should that be 16 or should that be 6?
No, there's tax credits. There's different tax credits as you make more. That's how it is. Because you get a gross up and you get a tax refund, but you get a gross up under 15 grand, but you don't get a tax credit. You only get a tax credit after the 15. So let's put it together. 4 more slides. Can we do 4 more?
Yeah.
80 grand of cash flow. Here's the situation. 80 grand of cash flow. Can you retire on 80 grand? If you're a reasonable human being, paid off your house, blah, 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 right? This person has 30,000 or RRSP income or CBP, OAS, something that's taxed, okay? They're gonna have interest income of 50K at a bank. Their taxable income is 80K because interest income and interest income, it's the same. It's taxed as income, 100% inclusion rate. You with me? 30K in income, 50K in either bonds or GICs. Bonds are taxed as income. The average tax rate is 24%, and the taxes paid is $18,889. If I meet someone and they got $1 million invested, and they're pulling out 50 grand a year, and they're paying 20 grand a year in taxes, almost feels like 20 grand. After late fees, it'd be 20 grand. Okay. Now we're going to move that to dividend income. Are they still have 80 grand of income or more than 80 grand? Why is their income now 99,000? They get a gross up, but then they get to deduct what the corporation paid. So now they get a gross up. Average tax rate is 10% because they get a tax credit. Taxes paid is 10,000. This affects you if you're in the OAS market. So you're going to get your OAS clawed back in this situation, but the previous guy won't get his OAS clawed back. That makes sense? You get 15 cents for every dollar you're over or something.
We also pay a lot less taxes in this scenario.
Yeah, this would be better. They would just move all the money to a bank to a dividend paying company, and the next year get dividends instead of interest. Boom. It's instantly to set that up. Taxable income jumps to 99,000 may affect your OAS. Could I tell someone, hey, listen, you're invested at the bank, why don't we move to dividend paying mutual funds? Canadian Dividend Fund, that's what it's called. Equitable Canadian Dividend Fund, Believe Canadian, whatever the Canadian Dividend Fund mostly has Canadian dividend interest getting kicked out. So the guy gets a gross up and a tax credit. If he makes under 50 grand, it's a big blessing. Over 50 grand, capital gains looks better. Now, 30K, now he's in a growth fund. Growth fund doesn't own dividend stock, it owns growth stock. The average, this is now 10,000, similar tax, but your inclusion rate is different. So 50 grand here Why is their taxable income only 55 grand? Because only half of the capital gain is included. So a guy who works part-time wants capital gains because you have a lower taxable income. Your average tax rate is the same, but your marginal tax rate is far lower because you have lower income. So when you're talking to clients about how to invest, how things get taxed makes a difference. Now, if you have a money and you're pulling out capital gains, you usually don't pull out the gains in a mutual fund, you pull out pro rata ratio or just return of capital. 30K in income, 50 grand in return of capital. The average tax rate is 10%. The taxes paid is 2,901 on 80 grand of cash flow. Is that better?
Yeah, it's better.
We're not talking about rate of return. We're just talking about return of capital. They're going to draw their capital first and then draw their capital gain later. And you don't pay tax on an unrealized capital gain. You just don't sell that part of the fund.
Right.
Low income allows for drawing your RSPs out. And if you have children, you get more CCB. This guy's got 30 grand of income. So you still get a bunch of tax credits. Maybe the old guy married a young woman and had a bunch of kids. Then they buy this fish. You make money, your employer will tax it for you. Don't worry. But if you save money, you better plan the taxes out. If you save money, if you spend money, tax it. If you die, they're going to tax you too. Common mistakes. The law requires you keep all your records of transactions to support income and expense claims. The CRA will not accept bank or credit card statements to justify deductible expenses. You need a receipt. Now, you can use your banking for tracking and reporting, but not for proving. If you don't file a return, if you owe money, you file late, you pay a 5% penalty and 1% a month. So let's say you owe 8 grand. You're 1 day late. Well, you owe $400 for being 1 day late, and every month you're late after that, you owe 1%. So if you're a year late, filing 8 grand, that's what you pay. It's cheaper than a credit card. So if you have a bunch of credit card debt, don't worry too much. Get yourself in a good position. Pay these guys too. These guys have the ability to prison. Okay, so it's a criminal offense to not pay your taxes. Tax planning is not just for the wealthy. It's for anyone who does not want to throw money in the garbage. Begin to work as a sole proprietor to have tax efficient income. Is that a good suggestion?
Yep.
Track and increase your investments invest in your income. It's tax deductible. And the number one tax shelter is doubling your income. Because if you double your income, you get to keep more money. Find your current tax, next year's tax, and tax far into the future. I do not want to get old and have only RSPs. It's like having only employment. Don't stop learning about something that has a large effect on you. A lot of people just give up on tax. They think, it's not in my control, but I think it is in your control. Especially if I'm going to turn 80 one day or 70, and from 70 to 100, I'm going to live on my investments. Fast forwarded, I would pay zero tax from 70 to 100, and I would get my full GIS. I have no taxable long-term investments.